Welcome back. Time now for the word on Wall Street. Top investors watching your money. Joining me now is Hennian & Walsh Asset Management President and CEO Kevin Mon. Also with us is the head of U.S. Equity Trading Strategy at Citi, Stuart Kaiser, back with us. Great to see you, gentlemen. Thank you so much for being here. And Stuart, I want to kick things off with you with a market this morning that shows futures lower on a half day of trading today. Of course, the stock market and the bond markets are closed today for the Juneteenth federal holiday. But here we are at the half point of the year almost. And we're looking at major gains in the market. All three major indices finished higher yesterday across the board, with the Dow up 72 and the Nasdaq up almost 500 points, almost 2%, despite 9 Federal Reserve officials pointing to the possibility of a increase in interest rates later this year. We also want to take a look at the expectations for the midterms and what else in terms of the growth story in the economy you're looking at. Markets were higher this week, Stuart. What's your best case for investing in these markets through the rest of the year?
Yeah, look, I think the best case here is earnings growth. And, I mean, it's been a tremendous year for earnings and earnings revisions. S&P 500 earnings are up 17% year to date on a 12-month forward basis. And frankly, I think that's what's been driving the market, without a doubt. We got a little bit of a hawkish Fed, obviously, earlier this week, and the market will have to digest that. But as long as earnings momentum is where it is, we think equities are going to continue to trend higher. Taking some of the tail risks out of Iran, obviously very, very positive. And, I think if we get gasoline prices lower and consumer sentiment continues to improve as a result of that, then you've got strong earnings, you've got a strong consumer spending trend going into the elections, and that should be very positive for the second half of the year, not to mention AI in the background, just an incredibly powerful kind of trend going on.
Absolutely. Probably the biggest CapEx spending that we've ever seen in terms of all these hundreds of billions of dollars going into AI. So would you stick with those AI players, growth names? Is that where you want to allocate capital? Because oil prices this morning are still below, $78 a barrel, as planned talks in Switzerland over the Iran deal were postponed. VP J.D. Vance not traveling to Switzerland to do the official signing, but the VP said 12.5 million barrels of oil moved through the Strait of Hormuz in one day, Stuart.
Yeah, look, I think lower oil prices, and as I mentioned, particularly how that flows through to gasoline and consumer spending is hugely positive. On the AI side of things, the spending is just massive. And our view is you want to be owning the stocks that are the recipients of that spending. And for us, that means the AI power generation story, I think from a thematic perspective, is just where you want to live right now. If you think those Mag 7 stocks are spending too much money, quote unquote, well, then the recipients of that money are where you want to be investing. So some call that AI bottleneck. We would call that AI power generation. We think that's the best risk reward, place to be invested in AI. Yeah, you may want to own a couple of the big Mag 7s in addition to that, but to us, follow the money and follow that spending, and that's probably the best investment idea we have for the second half of the year.
Kevin, do you agree with that? I mean, AI stocks rallied yesterday again, and they are up huge. Look at Micron Technology, up 8% yesterday alone. Taiwan Semi was up better than 6%. Intel rallied yesterday after President Trump confirmed that Apple has agreed to partner with Intel to design and build chips in the U.S. But if you look at these stocks, since the federal government, like Intel shares surging since the government took a 10% stake in the company last August, this stock is up 250% in 1 year. It is up 270% year to date. Of course, SpaceX is also soaring. The stock was down yesterday by 4%, but it's up huge since going public. It's up 14% since the debut of 135 when it first went public. And we've got more IPOs in AI on the way, Kevin.
Absolutely. And I couldn't agree with you and Stuart more. It seems like Stuart is reading from my playbook right now, because I believe there are more growth opportunities ahead if you follow where the money is going as opposed to who is spending the money. And that leads you right into AI infrastructure. And if Jensen Huang is right, and by the end of this decade, there's between $3 to $4 trillion spent on AI infrastructure, and we're only in the early innings right now, that means you continue to lean into the data center construction companies, the electrical connectivity companies, the cooling providers, the power solutions. That's where the money is being spent. That's where the growth opportunities are now. Maybe down the road, Maria, we'll start to see some returns on investment on all of this spending coming from the hyperscalers, but that's down the road. The growth opportunities today are in that infrastructure build-out, which took place prior to the onset of Operation Epic Fury and will continue to take place throughout the balance of this year, if not the balance of this decade.
Well, so would you put new money to Intel right now? Just to correct, Intel is up 520% in the last year. Do you want to put new money to that stock right now, or do you want to lay off semiconductors for a while?
It depends on which semiconductors. We like Intel at these levels. I often get asked the same question, Maria, about Micron Technologies, given the rapid ascent of their stock price, yet they're only trading at 10 times forward valuation. So there's so much demand going into these different types of chip plays and AI infrastructure plays that valuation should be a consideration, but you also have to look at forward earnings potential. And right now, forward earnings for a lot of these names is very strong.
Great point. What do you both think about all this money in money market accounts? Look at this chart that we have. Money market assets are up to $7.9 trillion. I mean, we've been talking about how, there was $7 trillion in money market accounts. Now, in just the last couple of months, now we're at $7.9 trillion. You've got government prime and tax-exempt money market funds higher. And Kalshi traders are talking about a better than 50% chance that the Fed hikes interest rates this year after those 9 Fed officials projected at least one rate hike this year. Stuart, do you believe that when you have this kind of money in a money market account that ultimately that money finds its way into the stock market?
Look, Maria, I think some of that money ultimately finds itself in the stock market. I think some of that money probably historically would have been in a bank account and is in a money market account now to earn a higher yield. So when you see those balances increasing, I think what you're seeing is, when interest rates are higher and you're actually receiving interest on your money, then that money is going to get put there. So I wouldn't assume that all of it goes into equity markets, but certainly some of it will come into equity markets, and that's an incremental positive. I mean, this is an equity focused kind of country and culture we live in, and I think ultimately if the equity markets continue to perform well, it'll free up some of that money market account money to come into the stocks eventually. Not all, but some definitely.
What do you think, Kevin?
Yeah, it's another potential tailwind for the equity markets. Some of that money could be used to allocate towards future IPOs, which we anticipate coming down the road. But I wouldn't necessarily assume that there is a hawkish tilt with the Federal Reserve right now. Maria, you correctly point out that 9 of the voting members voted for or are forecasting one potential rate hike of 25 basis points this year. But 8 other voting members thought there'd be no activity with interest rates, and 1 voting member thought there would be an interest rate cut of 25 basis points. So I wouldn't be surprised if there's no interest rate activity at all this year, and Kevin Warsh continues to focus on changing the manner in which the Fed operates and the way the Fed communicates, and both of those areas are good for the markets and the economy.
And do you believe that this rally since the end of March then has legs toward year end?
I really do, unless, of course, the memorandum of understanding starts to unwind, it re-escalates in terms of the military conflict in Iran, the strait gets closed again, and oil prices start to shoot up. Then a lot of what we've seen in this rally will dissipate, and investors will start to question more potential rate hikes coming from the Federal Reserve as a result of those inflationary pressures.
All right, gentlemen, great conversation. We so appreciate you both, Kevin Mon and Stuart Kaiser. We'll be right back with Pennsylvania Senator Dave McCormick. You're watching Mornings with Maria on Fox Business. Stay with us.